smartphones and tablets.
On the line in Whitby, Ontario is Ian. Good evening.
Oh, good evening, Mark and David, and thanks for taking my call. I wanted to ask about Husky. They've had their new leadership in place there for a little while now, and the company pays a pretty significant dividend, and I wondered what you thought going forward. I'm a long-term investor, and perhaps if you could compare it with Imperial. Thanks a lot.
Okay. So first of all, yes, there's a new leader there, and there's changes taking place, and I think that some of those changes, are going to be coming along over time. I think it's probably a little bit early on that. When I look at Husky, one of my concerns is the lack of growth in the business, and the dividend yield is attractive. 4.8% dividend, and it's certainly well covered. So that's a positive. When I compare it to Imperial, the one big difference that jumps out is the technical picture on Imperial Oil is just so much better. If I look at the big oil companies in Canada, the two that stand out to me are Imperial and CNQ. The two of those companies, I think, look better, certainly technically.
Since early October, IMO has looked really good.
It has, and it's interesting because you look south of the border at Exxon, and it's in the same sort of position. I mean, two very different companies, but some similar routes. And that hasn't been the case in some time. So I think that I would go kind of with the leader in the group. The one risk that we face in the energy space is that oil prices are elevated because of what's going on in Iran. When you look at consumption in the U.S. Was down year over year in December. You've got a bunch of new production coming on. It's not impossible to see oil prices back off a little bit here. It has been the best performing commodity over the last few months, which is good. I think I would probably go to the Imperial first and Husky second.
And Imperial IMO broke through its 200-day moving average. Was that significant for you?
Yeah, I think it is. I think it is significant. That company's gone through a huge changeover in its shareholder base, and there's been lots of time for that to take place. And so I think that there are fewer built-in sellers in the stock at this point, and I like the mix of business.
All right, here's Carol, who is in Edmonton. Good evening.
Good evening, gentlemen. David, I'm an old lady, and I'm looking for some recommendations for a TFSA that has a yield.
Okay, so here's an idea for you. I mean, I like your last piece of your question that has a yield. I think that the big problem in a smaller account is business risk. If you have a specific security, you may have an issue. So I am a big fan of using ETFs. We run an ETF fund, which we actively manage. And when I look at the things that are doing well out there, clearly dividend-paying securities are one that really stand out. So I would look at the FDL, which trades in New York, which is a dividend payers ETF. It's actively traded. It pays a yield just a little bit below 4%, but one that should grow over time. And I like the idea of using an ETF or ETFs in those types of accounts.
And you're looking at the U.S. instead of a Canadian dividend payer. Why is that?
I am because, and this is, I think, going to go on for a while, I think U.S. dollar is going to continue to be very strong against the basket of world currencies. And so we like the idea. We also like some of the large global dividend-paying stocks. We'll talk a bit about that as we go through tonight.
All right, then. Yeah, we've got one as a top pick tonight. So let's talk to Don now, who is in Ottawa. Good evening.
Mark. David, I'd like your comments on Cisco over, say, the next year. More to capital appreciation. Thanks very much.
You're sorry, Don, you're talking Cisco Systems?
Cisco, yeah.
Okay, very good, Cisco.
So in the space, obviously, Cisco is the dominant player. They've been fighting some of the margin battles over the last while because they've had competitors come in and sell product at lower margins. Hewlett-Packard's an example of that, trying to assail some of their space. I think, actually, if I was going to invest in tech, large cap tech looks the best. You've had almost 12 years now of multiple compression. Earnings have continued to grow. There is a view that a couple of quarters ago, John Chambers sort of threw everything in but the kitchen sink as by way of bad news. The stock has been behaving well really since early fall and beat their most recent estimate by 10%. So we do own some Cisco. The only thing I'd be concerned about is seasonally, as you get into January, it tends to be the tech stocks underperform a little bit. But as far as something to own, I think Cisco is a good one.
And we'll stick with tech here. We'll talk to Rocco, who's in Montreal. Go ahead.
Gentlemen, Happy New Year.
Happy New Year.
My question is on Intel. It's a stock that I've seen recommended here and there and everywhere. What's your feelings about Intel? And also, you answered part of my question. Is it a good time to buy U.S. stocks as a Canadian with Canadian cash? By converting it, are we losing any money doing that? Thank you, and I'll listen to your answer.
Great. So we do think it's a good time to be buying U.S. stocks. I do think it's possible we could see the Canadian dollar back off a little bit, unless you see commodities really make a significant turn, and I'm not seeing a big sign of that right now. Intel is another one of the companies that falls into the mega cap technology space, and you know, the nature of these companies have changed so much in the last 10 years. You know, if we talked about this 10 years ago, to think about Intel paying a 3.3% dividend. And one that is growing quite smartly. You know, they've been growing it at over 10%, the dividend. Company will earn something like $2.40 this year. The dividend's 80 cents, so there's certainly room to raise the dividend. And I think that you're going to see a lot of big American companies conscious of the valuation lift that they get by showing a rising dividend, increase their dividends this year. Last year, the S&P 500 dividends went up 14%, which is a significant lift. And big corporations have lots of cash. They've got, they're paying out record low payouts. In the 1930s, the dividend payout on the market was about 90%. And it went down steadily every decade till 2000s, where it was around 35%. I think we're seeing that start to lift. So we like the very large technology companies. We like the ones that pay dividend. And Intel, absolutely a leader in the group.
And buy it here, even though it's doubled since the market bottom in 09?
Yeah, no, I'd buy it here, and certainly, you know, you'd love to see it pull back to $24 or 24 and a bit. But at the end of the day, if you're buying it, maybe buy half a position now. And if the market has a little bit, comes in a little bit, we've rallied a fair bit in the last couple of weeks, you'd have an opportunity to buy the second half.
And just for the record, do you own Intel and/or Cisco Systems?
We own both of them.
You own both, okay. All right, let's take a short break. We'll come right back with David Burrows. We're going to get a look at his past picks right after this.